Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss health savings account adoption, gambling losses and taxes, 530A accounts, and a look at the Plan Solutions Incorporated Office Bulletin Board. Mr. Armour, how are we, good sir?
Doing well. We've had some great weather for February, so that's been nice. And I know this will come out a little bit later, but Super Bowl's this weekend, so mark the official end of football season. Is hopefully we're working our way closer to spring.
Who you got for the big game?
I hate to say it. I wish they could both lose, but but I think Seattle's going to be tough to beat.
Agreed. But the nice thing for me is that motorsports kicks off. So me, it's that wonderful time. Especially some of them last all the way into December. So I'm excited to see Formula One cars getting back out on track soon. NASCAR's out there, all that stuff. So I get to enjoy that form of sport that I really, really enjoy.
Yeah, that'll be fun.
All right, well, let's dive right in. Health savings account adoption. Let's go into what are health savings accounts and some of the advantages.
Yeah, so health savings accounts have been around for quite a while, and it was a new law that was designed to kind of shift some of the financial burden to the consumer making the decisions. That was the idea, right? In the old days, it was if you had health insurance, you maybe had a small copay or something like that when you used it. But, that was a pretty small amount of money. And so it would, it didn't prevent people from using medical care, even when maybe they didn't necessarily need it because of the relatively low out-of-pocket costs. The idea of the health savings accounts was we would shift people to high deductible health insurance plans, right? So really they were on the hook for, the X amount of first dollars. And then they might be a little more careful about, how they wanted to access healthcare because the first, thousands of dollars are coming out of their pocket. And if they don't use it, they get to keep that money and carry it forward, right? And if they do use it, then that's fine. And if they have a, bad year and significant costs, then eventually the insurance would kick in and act like a normal policy. So that was the idea behind it. And then to kind of pave the way in that direction, they created these health savings accounts. So to be eligible, you have to have a high deductible health plan. Like I said, you're taking on responsibility for those first X number of dollars of healthcare spending. But then you can put money aside, federally tax deferred into this health savings account as a way to, save up money to pay for those potential high deductibles in the years that you need to access care. And even use it for some other things. It can be more broad into things like dental, orthodontics, chiropractor, right? Things that maybe normally wouldn't have been covered by health insurance. So for some people, it was a more flexible plan in terms of how they consume, spend their healthcare dollars typically. And you had what they call the triple taxed advantage, at least on the federal side, where you get a tax deduction when the money goes in. Money can grow within the plan, tax deferred. And then if it's used for qualified health expenses, the distributions are tax free. So, both the contributions and the growth are not taxed, which for, people in a higher tax bracket can be a pretty significant savings, right? I mean, if you're in a 32% tax bracket, that's basically a third of your expense that's now covered by the federal government in the form of lower taxes rather than coming out of your pocket.
Yeah, absolutely. What really makes someone eligible to use an HSA? I know that I've seen this option for myself over the years. We've conversed, wasn't the best option to exercise, being that I was in pretty good health. I mean, I think I go do my regular checkups and things of that, and things that are appropriate to the age bracket that I'm in now to go get certain stuff checked out just to make sure. But in really good health, so it was kind of not necessarily advised for me.
Yeah, it depends on the different options. It's not the right thing for everyone. I mean, the first is you have to be under age 65, right? So once people go on Medicare, doesn't qualify as a high deductible plan. So at that point, they won't be able to access a health savings account. But generally, it works best for people that don't use a lot of medical services, right? If someone has some chronic conditions or things like that, where they have to see doctors regularly, if they use a high deductible plan, they'll probably have a lot of out-of-pocket costs, at least until they hit that deductible, and it likely won't work. But if you're in a position where it's pretty rare that you may go to the doctor in a given year, maybe just for a checkup or a few things like that. Then you're not going to be paying out of pocket. So the money that you put into a health savings account can just accumulate over time and be available if you do have that really bad year, right? If you go through a period of poor health where you're needing a lot of healthcare services. But by that point, you may have accumulated a significant enough amount from previous savings that you'll still come out ahead.
You stated that it works similar to an IRA. How is that? I mean, is it just qualification rules are similar, or what aspects of it are similar to an IRA?
Well, the similar part to an IRA is that you get a tax deduction when you put the money in, right?
Hmm.
So that's for starters. And then just like with an IRA, as long as the money stays in there, it grows tax deferred. So you're not taxed each year on whatever the earnings may be. Now the differential, well, it's kind of a difference and also a similarity is that, with a health savings account, if the money's used for qualified healthcare expenses, then it's not taxed.
Hmm.
Whereas with an IRA, when you take the money out in retirement, typically you're going to pay taxes on it. But where there's a bit of a crossover is if people have money in a health savings account when they turn age 65 and they're now on Medicare, they actually can transfer that health savings account into an IRA.
Oh.
So they can turn it from a healthcare account into a retirement account. Of course, then it would be subject to the IRA rules where any distributions they take would be subject to income taxes, right? But they still would have got the benefit of the tax deduction when the money went in. They would have got the benefit of the tax deferred growth, and then they'd pay taxes when it comes out. So it'd be very similar to an IRA, or basically, in a way, increasing the contribution limits, right? That they could get into a retirement type plan. Although in many cases, unless someone's accumulated a significant amount of money by the time they're age 65, often it makes sense to just keep it in a health savings account, and then use it to for, pay for some of those out-of-pocket expenses that you may incur under Medicare, or even some Medicare premiums, right? So the supplemental plans that you have to cover the things that Medicare doesn't cover, basically the private insurance portion of Medicare. In some cases, you can use health savings account money to pay those premiums.
Okay, thanks for that clarification on that. What are we seeing as far as 2026 when it comes to contribution limits, individuals, families, and is there variation upon that based upon age?
Yeah, so it depends on the type of plan. If you have an individual plan, you can contribute up to $4,400 per year into a health savings account. If the plan covers really two or more people, right, becomes a family plan, then you can contribute $8,750 into a health savings account. And then for those that are over age 55, there's an additional $1,000 catch up. So again, very similar to retirement plans where as you get older, they give you a little bit more that you can put in and get the tax deferral.
Speaking of retirement, what about when you become a retiree? What if somebody retires at age 55? Does it look different for them?
Well, it could give them more flexibility on what type of health insurance they choose, right? Because if they have a fair amount saved in a health savings account, maybe they can take a lower cost health insurance plan that might require a little bit more out of pocket when those services are engaged. But they have the money set aside to offset that risk, right? So it can give them, additional flexibility. The other thing about health savings accounts that really is becoming more and more prevalent is when they first came out, they were literally just kind of treated like savings accounts, right? You'd put the money in, might earn a little bit of interest depending on your provider, and then you pull the money out to pay for expenses and maybe carry some over from year to year. And given that the contribution limits aren't real high, right? These accounts are not necessarily going to build up over time very quickly. But now they've been around for so long that, we're running into people that have pretty substantial balances in those health savings accounts because they've been relatively healthy, haven't needed to access it very often, and have contributed the max each year. And that's where the second piece of a health savings account that's really becoming more prevalent, which is the two types of sub accounts. One sub account is kind of a checking account where money goes in, money comes out to pay for expenses. In many cases, you're even given a debit card or a credit card that access, directly to the account, so you can use that to cover those expenses. But the other piece is actually an investment account. Now, most providers require that you have at least a minimum amount in the checking account. But once you go over that, you have the option of shifting it where it could actually be invested for growth. And if you've accumulated a substantial amount that you're unlikely to need over the next year or two, even if you have a rough year and incur a lot of healthcare expenses, it can make sense to shift that into the investment side, where you can get, a better potential rate of return, which can help to offset the effects of the high healthcare inflation that we've seen for many, many years.
Yeah, thank you for sharing that around that. That's really interesting how this has adjusted over time, and I definitely know in the conversations we've had about it over time that those changes have come to fruition. What do HSA owners maybe want to consider when using the account as an investment option?
Yeah, I think it's really an individual type situation, right? Like we talked about. The first is a high deductible plan right for you? And if it is, then, how much can you then, contribute to a health savings account to offset the risk of that deductible? And then as you build it up, it's okay, does it make sense to invest some of this money for the longer term to, really think down the road to potential healthcare expenses 3, 5, 10 years down the road? And then depending on the amount you have and what those targets are, what's the right level of investment risk that you should take, right? You don't necessarily want to, be really high risk because, you don't want to be in a situation where you incur high medical expenses, maybe a couple years in a row during a period while the market's down, right? So just like with any other investment, you want to be, weighing the risk return profile and where's the right fit. So it really is something where, people should engage a professional to talk through their options, because there's just so many different factors and complexity, and is so very individualized. I mean, obviously healthcare is individualized. Financial planning, personal finance is an individualized thing, and this is where they really come together, and kind of the two combined even increase the complexity more than maybe other investment decisions.
Yeah, absolutely. Anything else you want to add before we jump to gambling losses and taxes?
I just want people to be aware that, we've talked about federal law here, but all the states have different laws as well. Some of them don't conform to the health savings account rules. So you just want to be aware of what impact it may have in your state. Because that can be another one of those factors, right? That adds to the complexity and needs to be taken into account.
Absolutely. All right. Gambling losses and taxes. Gambling typically not a great way to build on your investment portfolio. Of course, unlike stocks and bonds, which have a positive bias, gambling obviously a negative. You're not designed to win. That is for sure. This means that hey, the longer we kind of engage in it, the odds and percentages are likely that we're going to come at a loss. But what does this mean as far as when it comes to taxes and gambling losses?
Yeah, it's always interesting with gambling. You see those billboards like in Reno or Vegas, right? That say, we have the best slot payout percentage, 97%. And it's like, well, wait a minute. So on average, if I do this long enough, for every dollar I put in, I'm going to get 97 cents out, right? And that's the best. That doesn't, doesn't seem like a great opportunity. Whereas investing, right, the longer that you're engaged in investing, the more likely you are to profit, right? Because it's had a positive bias, an upward trend over time. Because of that, the IRS has not been a big fan of gambling in general. That's the other part that potentially makes it even worse of a trade-off, right? Because when you gamble, gambling winnings are subject to taxation. Now, historically, there's been a provision in the law where you could deduct gambling losses, but you deduct gambling losses as an itemized deduction. So in some cases, those losses and those winnings and the deduction do not line up, right? And people still end up paying a fair amount of tax on their winnings when for the year, right, they may have had net losses. So that's always been a negative. But now with recent tax law changes, it's getting even worse. So starting in 2026, the new IRS rules for gambling losses put limits on the amount that you can deduct as losses. So now your losses deduction can only be 90% of your winnings. So, if you go to Las Vegas, a couple times a year, and let's say, you win $1,000 on one trip and you lose $1,000 on the next, you've broke even, right? But you'll have to report the $1,000 of winnings as income. You'll only be able to claim a deduction of $900. So you're going to pay taxes on $100, even though you didn't come out ahead $100. And that's assuming that you're already have sufficient itemized deductions where you would have been itemizing anyway. If you're not itemizing, you may end up paying taxes on that full $1,000, even though you were, basically a net break even. So, it's just something for people to be aware of because, gambling, already, right? Maybe as a form of entertainment or something like that, but it's never been real attractive from a financial standpoint, hasn't been very attractive from a tax standpoint, and now even less so.
Yes, sir. Just out of my own inquiry, what happens? Let's say somebody does make a big win. Let's say $10,000. Is it the individual's obligation to do a reporting, or let's say it's something they hit on the slots, they go and they trade in that ticket, whatever it is. Are they then issued something from the casino that they then have to include in their taxes? But on the other side of it, they need to monitor the amount of losses. How does that work?
Yeah, so there are federal regulations that require any gambling establishment to issue 1099 Gs for any time someone wins over a given amount. And that can depend on, a lot of things, right? But usually it's not a real high dollar amount. And so, yeah, then you'll be issued these 1099 Gs that are also sent to the IRS. So they know to look for that income. In terms of losses, that can sometimes be a little tricky. Now, someone can use a contemporaneous log, right, to show I gambled on this date, I lost this much money. That is admissible. But typically what happens these days is it's linked to a player's card or a rewards card type thing, right? So, people that that are big gamblers, typically that's the first thing is hand over that card when they're playing so that they're getting credit because also, casinos will give them different rewards, freebies, sometimes trips to other resorts to try and keep them gambling. But you can actually contact the casino and they can run a report of money in, money out, at their, I won't say necessarily establishment, their brand, right? Because a number of the casinos nationwide are owned by some of these big gaming companies, and they can run a report across, all of their different locations to give you the information that you need to be able to, well, keep track of the losses, but also, justify it if the IRS should question them.
Okay, thank you. Appreciate it. All right, let's dive into the 530A accounts. What are 530A accounts?
Yeah, 538. I mean, that's the kind of the name, just like with 529 or other accounts like that, right? Because that's the name, that's the code section, the IRS code section that creates them. But a lot of people, refer to them as the Trump accounts, right? That they created these new accounts where basically starting this year, 2026. Parents are eligible to open these 530A accounts for eligible children who have a valid Social Security number and are younger than the age of 18, just by submitting an IRS form 4547 using an online portal that isn't actually available yet, but is supposed to be available later this year, or by funding it through their tax return, where they can make contributions into these accounts. Now, they're kind of interesting accounts. I've had a lot of conversations with clients, and the question, does it make sense? Are some of the existing options really that we've already had superior? Or it could be additive, right? If someone's already maximizing the opportunity of other accounts, they can contribute up to a total of $5,000 per child per year, into this account. And unlike other types of retirement accounts or college accounts, the child does not need earned income, and those contributions don't affect their eligibility to fund other types of accounts. So it is additive. And of course, the big draw is children that are born. The federal government will contribute $1,000 to start the account. So in that case, it's a no-brainer, right? If you have a new addition to the family, child that's born this year and they're eligible, just by filling out a form, they get $1,000 to get the account going, and you're really under no obligation to contribute any more than that. You can just leave that $1,000, but you do have the option, family, employers even can make contributions, some matching contributions and things. So there are a number of different ways to fund these accounts. That's a little more broad than some of the existing options.
Yeah, interesting. So, what happens then when a child turns 18? How does it work? Similar to other types of accounts or differ?
Yeah, so that's the tricky part. So generally, no withdrawals are allowed until they're 18, and then once they're that age, it's subject to a lot of the same rules as a traditional IRA. So, while the account grows tax deferred, the taxation of the distributions will be depending on the funding and the basis of the account of what was put in. So there could be some tax implications. There's also certain things that it can be used for education and things like that, without incurring a distribution penalty. So, the contribution side is a bit more flexible than some of the pre-existing options, but the distribution side does come with strings attached. And so it's really worth looking at, because sometimes a custodial Roth, maybe a parent funding a Roth instead that's earmarked, can offer more flexibility. And of course, if education is the goal, then a 529 plan may offer more flexibility and from a planning standpoint in terms of distributions.
All right. Well, let's jump on over to the Plan Solutions Incorporated office bulletin board. We've got two items pinned up there. Chase, what have we got?
Well, tax season's here. We're in February, and the IRS officially announced they're accepting tax returns But what we're finding is some of the state agencies are not quite ready yet. There's some forms that have not been finalized. And in addition, some tax documents are just not due yet, right? A lot of them are due by the end of January, but some of the more complex forms will take a little longer. But we'd still encourage people to not wait. It's always better to get started early, even if they don't have everything that they need. If they have the bulk of it, they can still, send it in, and we can get started on it. And so, if it's just a few late filings, obviously one of the challenges of tax season is once those filings start to come out, right, it creates just this deluge of tax information coming in because everybody's been waiting on those. Whereas if someone wants to, get a head start, if the tax return's mostly done and we're just waiting on a few pieces of information, then once that information becomes available, the tax return can be completed much faster than if we're starting from, square one in preparing the entire return at that time.
Yeah. What's the second item you got pinned up there? It looks like yourself, Daryl, Carter, and Matt all got out of the office and did some continual education.
Yeah, we attended the Financial Planning Association of Northern California Winter Symposium. They do these once a quarter, and once again they did a great job. They've really been putting together a solid slate of speakers. They had some representatives from J.P. Morgan that did a review of the current economic climate. That was interesting. Also, kind of a relief. It gave me a break. I think they had me do the economic update 10 or 12 years in a row or something like that. Because they kept begging me to come back because they said it was really highly rated, right? But finally, they've been able to find some other options, and they did a great job, which was good. And then there was a tax professional that did a review of changes to the tax laws. Actually, a CPA named Dan Stazak, who's right across the parking lot from us. So he's kind of a neighbor, but really good guy, great personality, actually makes learning about tax law changes fun. So that was a great one. And then kind of an interesting one with an organization that specializes in advising private foundations. So basically people saying, okay, I want to set up my own foundation to fund these certain causes. And they did a really deep dive on the giving and kind of more important for us, the investing rules for private foundations, which was fascinating, some of the intricacies and opportunities that are there that have kind of evolved over time recently. So kind of an eye-opener into an area that we don't delve into very often, which is always good. You want to expand your horizons and at least have some understanding of these areas in case it should come up.
Yes, sir. Absolutely. Well, Chase, anything else you'd like to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
No, just like say thanks to everyone for their time. Thanks for listening. Any questions that come up about any of these topics, by all means, reach out.
Absolutely. And please hit that subscribe button if this is your first time listening. Apple Podcasts, Spotify, leave us a rating and a review. And if you want to follow along to a visual form of the podcast, you can go to the YouTube channel, which is youtube.com/@plansolutions. It'll have the personal financial review, the written content that we discuss here on screen, and you can hear Chase and I discuss it there. So if you are a visual person and would like to do that, head on over to the YouTube channel. And of course, if you want to subscribe to the personal financial review, simply send Katie an email. It's katie@plansolutions.com and let her know you want to get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.